This is Anthony Galliano for B2B Asian News, reporting on the recent threshold of $40 trillion of U.S. government debt. U.S. debt crosses $40 trillion as market pressure spreads globally. The United States national debt has crossed $40 trillion for the first time, a historic milestone arriving during sharp volatility in government global bond markets. According to the U.S. Treasury Department, total federal debt includes around $32.3 trillion in Treasury securities held by the public and approximately $7.7 trillion held with the federal government. The distinction is important. Intragovernmental debt includes obligations to accounts such as Social Security and Medicare trust funds. Publicly held debt includes Treasury securities owned by banks, pension and investment funds, companies, individuals, foreign governments, and central banks. For financial markets, the $32.3 trillion held by the public is the more immediate concern because it must be regularly financed through the open market. Debt reached $39 trillion only 5 months ago. A decade ago, it stood at approximately $19.4 trillion. The debt increased under both Republican and Democratic administrations, including substantial emergency borrowing during COVID-19. However, the underlying problem is broader than any single administration or crisis. The U.S. government continues to spend substantially more than it collects. For fiscal 2026, federal revenue is projected to be approximately $5.6 trillion. Compared to spending of about $7.4 trillion. That means the government is spending around $1.33 for every dollar it receives. Around 60% of the federal budget goes towards mandatory programs such as Social Security, Medicare, and Medicaid, while much of the remainder is divided between discretionary programs, including defense and interest on the debt. As of July 2026, maintaining the federal debt has cost approximately $1.17 trillion during the fiscal year, equivalent to around 19% of the total federal spending. Recent developments in the bond market demonstrates how pressure is building. On Tuesday, August 18th, the 30-year U.S. Treasury yield climbed to approximately 5.34%. Its highest level since 2007. Bond prices fall when yields rise, meaning the move represented a significant sell-off in long-term government debt. Investors are responding to persistent fiscal deficits, the volume of Treasury securities entering the market, geopolitical risks, and doubts about how quickly the Federal Reserve can lower interest rates. The failure to achieve a diplomatic breakthrough between the United States and Iran has intensified concerns about oil supplies and energy inflation. Oil above $90 per barrel increases transportation and production costs and can feed into consumer prices. If inflation remains elevated, the Federal Reserve may need to keep rates higher for longer and placing further upward pressure on Treasury yields. Another source of pressure is increased corporate borrowing connected to artificial intelligence. Technology companies and infrastructure providers are raising substantial capital to finance data centers, semiconductors, power generation, and electricity networks. Investors are therefore being asked to absorb heavy government borrowing and record financing requirements from the technology center simultaneously. International demand is another factor. Foreign investors own close to 1/3 of publicly traded U.S. government debt. However, some central banks and sovereign institutions are gradually diversifying their reserves into gold and other assets. Volatility matters because Treasury yields form the foundation of global financial pricing. The 10-year yield is an important benchmark for mortgages, business loans, government borrowing, and investment valuations worldwide. The 30-year yield reflects expectations about long-term inflation, economic growth, and fiscal credibility, When Treasury yields rise, borrowing costs generally increase across the economy. The impact on equity markets can be significant. Government bond yields more than 5% offer investors an attractive alternative to stocks. Some capital may move from equities into treasuries, particularly if investors become concerned about economic growth. Higher rates also reduce the present value of companies' expected future earnings, placing pressure on high-growth technology shares. Rising financial costs may also make some data center, energy, and artificial intelligence investments less attractive. The effects have moved beyond the United States. International government bond yields follow Treasury yields higher during the initial sell-off. Because Treasuries are a global benchmark for low-risk returns, rising American yields force governments and companies elsewhere to offer higher returns to compete for capital. Emerging markets are particularly exposed. When investors can earn about 5% from U.S. government bonds, they may become less willing to accept additional risk associated with developing countries. Capital can move out of emerging market stocks, bonds, and currencies and return to dollar assets. This can weaken local currencies, reduce liquidity, and increase financing costs. For Cambodia, the effects would be indirect but important. Because Cambodia is highly dollarized, persistently high U.S. rates can influence the cost and availability of financing for Cambodian banks, businesses, and households. Cambodian companies seeking international funding may also face higher borrowing costs because lenders use Treasury yields as a base rate before adding country and company risk premiums. Currency and commodity volatility could increase the cost of imported fuel and manufacturing materials. Higher oil prices would also affect transportation, logistics, electricity, and production expenses. There is a trade impact as well. If elevated rates weaken American household spending, demand for Cambodian garments, footwear, and travel goods could slow. Because the United States is a major destination for Cambodian exports, weaker demand, tariff uncertainty could affect orders from factories, investment, and employment. The key takeaway is the $40 trillion milestone is not simply an accounting figure. The more important development is the market's reaction to the growing volume of publicly held debt and the cost of refinancing it. The rise in long-term Treasury yields and the renewed bond sell-off demonstrates that investors are demanding greater compensation for fiscal, inflation, and geopolitical risks. For the United States, this means higher government interest costs and more expensive financing for households and companies. For the rest of the world, it means higher benchmark borrowing costs, volatile currencies, and potential capital outflows from emerging markets. And for Cambodia, the principal risks are higher dollar financing costs, more expensive imports, weaker demand for key exports, and greater uncertainty surrounding trade and investments. The United States may be carrying the $40 trillion debt, but the financial consequences are increasingly global. This has been Anthony Galliano for B2B Asian News, reporting on the $40 trillion U.S. debt milestone.